Hello everyone, in this unit we are going to learn about measures to correct disequilibrium in the balance of payment. Before that, let us understand what is the meaning of disequilibrium in the balance of payment. Though the debit and credit side are composed balanced in the balance of payment, it may not necessarily stay balanced. Regularly either the debit surpass the credit side, this is indicated as a deficit, or the credit side surpass the debit side, which is indicated as a surplus in the balance of payment account, which is referred as a disequilibrium. What is meant by surplus in balance of payment? At the point when autonomous receipt, that is credit, are more prominent than autonomous payment, that is debt, the balance of payment will be in excess or favorable. To state it in any case, assuming that total credit surpass total debit in the credit and capital account, counting error and omission, the balance of payment will be said to be in surplus. Deficit in balance of payment is explained as at the point when the amount received are more modest than autonomous payment, the balance of payment will be in deficit or adverse or unfavorable. To state it in and different way, when total debt surpass total credit in the current time capital account, the balance of payment is supposed to be in deficit. So far we have understood the meaning of disequilibrium in the balance of payment and two types of disequilibrium in the balance of payment, that is surplus in the balance of payment and deficit in the balance of payment. Now, we will discuss about various measures to correct this disequilibrium in the balance of payment. In the measures to correct this equilibrium in balance of payment, there are many policies and instruments available, like quantitative changes in import and export, required strategy changes such as fiscal, monetary and non-monetary related measures. The same of these approaches or policy can be elaborated as we discuss. There are three types of measures to correct disequilibrium in the balance of payment. First, monetary measures or instrument. Second, non-monetary or fiscal measures or instrument, and third, other measures. Now, we will discuss each measures and instrument in detail. So, let us discuss the first monetary measures or instrument. In the monetary measures, there are three different techniques used to correct disequilibrium in the balance of payment, that is deflation, change in the exchange rate and exchange control. Now, let us discuss about the deflation instrument. Deflation is nothing but falling prices in the economy. Deflation as an action can be utilized to correct disequilibrium in the event that there is a deficit disequilibrium. For example, at the point when the nation's imports surpass its export, this instrument is used to correct this equilibrium in the balance of payment. Deflation will in general make domestic goods somewhat less expensive to foreign product, which builds or increase the domestic export. This export will give more foreign exchange reserve to the country and there will be correction in the disequilibrium in the balance of payment. In any case, deflation would accomplish its planned impact just when the exchange rate does not change in the middle. So, this deflation instrument is used to correct disequilibrium in the balance of payment in this way. Now, let us talk about the change in exchange rate. Under this, there are two types: first, fixed exchange rate, and second, flexible exchange rate. Under the fixed exchange rate, devaluation of currency is used to correct disequilibrium in the balance of payment. Devaluation implies decreasing the value of our currency compared to the foreign currency through a purposeful attempt by the central monetary in India by the Reserve Bank of India. This devaluation is authorized through the authority and purposeful attempt of the central monetary authority in India, it is the RBI. This type of devaluation was used in India in 1991 when India's BOP deteriorated and the International Monetary Fund recommended devaluation of Indian currency. India devaluated its currency by 18 to 20% with regard to other countries' currency. This action decreases its import and increases its export. So, in 1991 we got the expected result from the devaluation. By and large, the valuation is an action used if there should be an occurrence of serious and favorable equilibrium of balance of payment situation in the country. The success of evaluation is reliance upon specific elements as that demand elasticity for commodity should be more or greater than unity. The elasticity of supply for the import ought to be more or greater than unity. Devaluation of ought not to be rely adverse in light of the fact that it will do nothing, and last devaluation of nations terms of trade ought not to be incredible adverse in any other way, it won't acquire a single things from the trade. There are some limitations of devaluation. These are as devaluation is fruitful when other nations do not fight back something similar in the event that both the nation go for something similar, the impact is nothing. Devaluation is fruitful just when the demand for goods and imports is elastic or flexible. Devaluation, however, helps correcting disequilibrium is used at weaknesses for the country's balance of payment condition. Devaluation may increase inflation, the accompanying circumstances. First, devaluation cuts the import down when import are diminished. The domestic stock of such merchandise should be expanded in a similar way. Second, a developing nation like India is capital purchased. Due to non-accessibility of capital product in India, we have no choice except for to proceed with import at a higher expenses. This will compel the businesses relying on capital merchandise to push up their cost at the point when demand for our export rises. And third, an ever increasing number of merchandise deliveries in a nation would go for export and subsequently making lack of such merchandise at the domestic level. These will outcome in rising cost of product and inflation in the economy. And fourth, devaluation may not be successful assuming the deficit emerge because of repeating or underlying changes or cyclical fluctuations. Now, let us talk about under a flexible exchange rate, what is the option available to correct disequilibrium in the balance of payment. The depreciation is the option available in the flexible exchange rate system. Exchange devaluation implies decrease in the rate of exchange of our currency with respect to foreign country currencies, but this will happen as per the market forces in the foreign exchange market. Assume the rate of exchange between Indian rupee and US dollar is $1 is equal to 40 rupees, and if the Indian balance of payment with respect to USA is unfavorable, then India required more the US dollar. The cost of dollar as per Indian rupee will rise and suddenly the dollar will appreciate and the rupee will devaluate in quantity according to each other. The new rate of exchange might be $1 is equal to 50 or 55 rupees. This means there is more than 25% depreciation in the exchange rate for Indian rupees. Exchange rate devaluation will support an increase in the export from our country and decrease the import from the rest of the world, because in this situation import will become more expensive here and export will become less expensive. So, ultimately this will improve our foreign exchange reserve and there will be correction in the balance of payment in India. But for this there are some limitations also, which are exchange depreciation will be good provided that there is no retaliatory exchange devaluation by different nation. Exchange depreciation rises the cost of import and diminishes the cost of export. So, the terms of trade will become adverse for the nation who is using it, and it might result in hyperinflation, bringing on additional deficit in the balance of payment. So, considering these limitations, this depreciation instrument we have to use very cautiously. Exchange control is another one instrument or measures available to correction in the disequilibrium in the balance of payment. The Reserve Bank of India or Central Monetary Authority of any country, they can restrict for any exchange rate or foreign exchange related dealing, and they can control exchange rate, which will improve condition of balance of payment in the country. In this way, this exchange control is used to correct balance of payment by the RBI. So far we have discussed all the instrument or measures of monetary policy which are available to correct disequilibrium in the balance of payment. But these instruments one needs to be used very wisely to correct disequilibrium in the balance of payment. Now, let us discuss non-monetary or fiscal measures or instrument. These measures will either limit imports or increase export. In this, there are 4 types of instrument available. First, tariff; second, quantitative limits or quotas; and third, export promotion; and fourth, import substitutes and replacement. So, now let us discuss the tariff instrument or measures to correct disequilibrium in the balance of payment. Tariff or taxes are levied on import from other countries. When tariff are levied on import of any goods and services, then it will increase the prices of those goods and services in the country. This will most time decrease the desire for imported trades of goods, and this will initiate more domestic supplier to create appropriate amount of import substitution. The import of significant product can considerably decrease through this action or strategy. There are some disadvantages of tariff, like tariff being balanced by decreasing the volume of trade, tariff deter the extension of world trade, tariff need not to be guaranteed to diminish imports. Thus, the impact of tariff on the correction of balance of payment is not clear. Tariff to be successful required an effective and legitimate organization, which is challenging to have in the majority of nation. And last, a new or higher tariff might expect the disequilibrium in the balance of payment of nation, which previously having a surplus or excess. With these limitations or disadvantages, one has to use tariff as a measures to correct disequilibrium in the balance of payment in the country. The second measure in the fiscal policy is quantity limitations or quotas. In this, the public authority or government fix the most extreme amount of specific commodity that can be imported in a specific period. This motivates improvement in the balance of payment circumstances by restriction on imports. The types of quotas are tariff or custom quotas, unilateral quotas, bilateral quotas, mixing quota and importing, permitting or licensing. There are few advantages of quotas, like quotas are more compelling than tariff or levies as they are sure. They are not difficult to carry out. They are more successful in any event when demand is inelastic and more adaptable than taxes as they are dependent upon authoritative choices. Similarly, there are disadvantages of quotas, like they are not long term arrangement as they do not tackle the problem of disequilibrium clearly. Under the WTO, quotas are not allowed and carrying out of quotas is an open door or invitation to corruption. So, this information gives us an understanding about what is meant by quotas and how it will help to correct the disequilibrium in the balance of payment with its advantages and disadvantages. Next measure is export promotion. The export promotion is an important measures to correct disequilibrium in the balance of payment. Under the export promotion, government they give motivation or incentives to the exporters to increase export, like tax incentives, credit subsidies or other money related incentives, arrangement of advertising offices and so on. These types of activities will increase export from our country to rest of the world. In the export promotion, the government can increase exports through exhibitions, exchange fairs, advertisement about the export, which gives more information about the export of goods and services to be various businesses sectors in the rest of the world. This will improve the export of goods, sell service from our country and we will receive more foreign exchange, which will help to correct disequilibrium in the balance of payment. Last measure in the fiscal policy is import substitution or replacement. If the government is facing a problem of disequilibrium in the balance of payment, then the government can increase either export or create substitute goods and services of import at the domestic level. This will decrease more import from the rest of the world and it will help to save the foreign exchange reserve and subsequently it will correct the balance of payment disequilibrium. There are some disadvantages of import substitution, like such enterprise might lose the spirit of competitiveness in the market. Domestic enterprises getting a charge out of different motivation will foster personal stake and request such concession constantly. And last, for first full promotion of import substitute business conflict with the rule of fair business practices or principle of competitive advantages in the economy. So, one can say import substitution is a crucial measure which we can use to correct disequilibrium in the balance of payment. So, we have completed all the fiscal policy measures or instrument to correct disequilibrium in the balance of payment. Now, we will discuss what are the other policy measures to correct disequilibrium in the balance of payment. In the other measures to correct disequilibrium in the balance of payment includes encouragement to the foreign tourists and visitors, motivation to foreign investment in the country, foreign loan and automatic measures or instrument. Let us discuss encouragement to the foreign tourists and visitors in the country. The public authority motivates or gives some incentive to foreign visitors or travelers to visit the nation, which will expand or increase for an exchange in our country. This will build more foreign exchange reserve, which will access to correct this equilibrium in the balance of payment in the country. Next is motivation to foreign investment in the country. The public authority can motivate the foreigners and outsiders to make an investment in the nation, offering them a wide range of financial incentives, concessions and subsidies that will increase foreign exchange reserve, which can be used to correct disequilibrium in the balance of payment. In many cases, we welcome entrepreneurs to contribute their capital inside the country. The public authority makes sure that this delivers no other repercussion on the economy. So, the motivation to foreign investment in the country can be used as an instrument to correct disequilibrium in the balance of payment in the country. The foreign loan can be used as a measure to correct disequilibrium in the balance of payment. The public authority can take loans or advances from foreign countries, banks or foreign respective country government to correct disequilibrium in the balance of payment. This type of loan will be available to the country for the long term period. This will assist the government to eliminate the deficit or shortfall in the balance of payment of the country. So, this is one of the measures to correct disequilibrium in the balance of payment. There are some automatic measures or instrument which will help to correct the disequilibrium in the balance of payment, like this type of measure was there in the gold standard system, which was naturally revised to the inflow and outflow of gold in the country. So, at the end one can say, to correct disequilibrium in the balance of payment, there are three types of measures or instrument available. First, monetary policy, second, fiscal policy, and third, other instrument. The respective government can use all these policy wisely and cautiously as per the available condition and circumstances in the country. I hope this lecture is useful to all of you. Thank you all.